Germany and Italy are asking the United States to send back a huge amount of gold, worth about $245 billion, that they've been storing in New York. But they're not just asking for a transfer on paper. They want the gold flown home by military planes. This isn't just a financial decision. It's a clear sign that these two major NATO countries are starting to lose trust in America's financial system, its leadership, and even the US dollar. This comes at a tense moment. The US has recently put heavy tariffs on European products like steel and aluminum, 25% and 10%, which has upset many leaders in the EU. Now, by asking for their gold back, Germany and Italy are sending a strong warning. And the big question people around the world are now asking is, if America's closest allies want their gold back, who might be next? Between June 23rd and 27th, 2025, the world saw what could be a major turning point in global finance. Germany and Italy, countries with the second and third largest gold reserves in the world, want to move a big chunk of their gold out of the US-Germany stores, 3,352 tons, and Italy has 232 tons, and 452. Over a third of that gold is sitting in the vaults of the Federal Reserve Bank in New York, and they want it home. The reason isn't just fear of tariffs. Many European politicians are worried that the US might freeze or seize foreign-held gold in future disputes. German politicians, even conservatives like Markus Ferber from the CDU party, are warning that President Trump could use foreign gold as a bargaining chip. The Taxpayers Association of Europe has also called for immediate action to bring the gold back. Italy's Prime Minister Giorgia Meloni promised in her 2019 campaign to repatriate Italy's gold. Now she's being cautious. With trade talks ongoing and Italy trying to protect its exports to the US, she's been quiet publicly but is clearly concerned. Italy stores 43% of its gold, around 700 tons, in the US. Some experts are warning that keeping so much gold overseas, especially under a volatile US government, is risky. Repatriating this gold is a big deal. It's not just about moving metal, it could shake up global markets. If countries like Germany and Italy pull their gold out of the US, they may also stop buying as many US Treasury bonds. That would push interest rates higher, including mortgage rates for American homebuyers. In fact, some economists say that even a small sell-off could raise mortgage rates above 6.9%. This is more than just financial policy, it's a statement. Countries are saying they no longer fully trust the US as the safekeeper of their wealth. Germany's push to get its gold back was once seen as a fringe idea promoted by the far-right AfD party. But now even moderate mainstream politicians are backing the plan. CDU leaders are questioning whether it's still smart to leave gold in American hands. Meanwhile, Italy is taking a quieter route. Meloni is trying to protect Italy's strong trade surplus with the US, worth over $40 billion. While still being mindful of the promises she made to voters. But even her silence is seen as a warning sign. Italy may not be far behind Germany in bringing its gold home. This shift is already influencing other countries. Belgium owns 227 tons of gold, and lawmakers there are now pushing to bring it back from storage in New York, London, and Ottawa. The Netherlands already moved 122.5 tons of gold out of the US back in 2014. Austria followed in 2015. Now, other countries like Poland and Switzerland are being urged to do the same. The big picture is changing fast. A recent study by the European Central Bank found that gold now makes up 20% of total global reserves, more than the euro's 16%, and getting closer to the dollar's 58%. If 5 more mid-sized countries move 1,000 more tons of gold, experts think gold could make up 25% of all global reserves by 2028. That kind of change would hit the US hard. Demand for US government bonds would fall by as much as $150 billion per year. Treasury interest rates would go up. Loans would get more expensive. And it would show that many countries no longer see the US dollar as the world's most trusted currency. Markets are already reacting. Reuters reported that the value of US Treasury bonds and other securities held at the New York Fed by foreign central banks has dropped by $90 billion since March. A huge $17.1 billion drop happened in just 1 week, the sharpest fall since January. Why does that matter? Those securities are often used as collateral in short-term lending markets. Less collateral means higher borrowing costs and more market stress. On June 24th, the New York Fed warned about sudden volatility in short-term funding and said it would step in to keep markets stable. Experts at Bank of America say that every $20 billion drop in top-quality collateral can push up the overnight lending rate by 3 basis points. If Germany and Italy move all their gold, that could raise the rate by 35 basis points. Enough to disrupt the Federal Reserve's efforts to control the economy. In simple terms, this isn't just about gold bars. It's about trust, power, and who controls the financial system. When allies start flying their gold out of your vault, it means they're thinking twice about your leadership. And as these gold-loaded planes head across the Atlantic, they carry more than metal. They carry a message. The age of unquestioned U.S. financial dominance may be ending. Trust is the real currency behind money's flow. As long as allies trust America, cash moves freely. But once that trust fades, they pull their treasure home, starving Wall Street's repo markets and forcing the Fed to print dollars backed by ever-shrinking assets. Cash can fill a gap overnight, but confidence holds the system steady for decades. Confidence evaporates when NATO cargo jets start flying European gold home. What was once tariff headlines now plays out second by second in the bond market. On June 24, 2025, the 10-year Treasury yield hit 4.43%, climbing steadily. Berlin and Rome quietly tested the market by trimming $4 billion in long-term treasuries, causing spreads to widen and traders to sound alarms. A few billion might seem small, but U.S. yields balance on a knife edge. When Japan dumped $17.5 billion in bonds in April, yields jumped sharply, triggering the biggest surge since 2001. Europe could deal a similar blow by selling $18 billion in one cycle, pushing yields higher and mortgage rates up. Every 5 basis points in the 10-year add nearly 9 basis points to a 30-year mortgage. With rates near 7%, that's enough to push home sales to a 30-year low. Car loans and infrastructure bonds also feel the pinch, with states paying higher premiums amid tariff jitters. This is no distant market drama. It hits every American driveway and job site. A gold dispute thousands of miles away ripples into costlier homes, cars, and roads. Confidence anchors currencies, but U.S. dollar faith is cracking. A June 2025 survey found 70% of reserve managers avoid dollars due to U.S. politics, double last year's figure. Gold has overtaken the euro as the second-largest reserve asset, reclaiming its spot after decades. Nearly 76% of central banks plan to boost gold reserves while cutting dollar holdings. Central bank gold buying has topped 1,000 tons annually for 3 years, levels unseen since Bretton Woods. If this trend continues, gold could reach 25% of global reserves by 2030. Each point lost from treasuries equals $100 billion evaporating from U.S. bond demand. Lose 5 points, and Washington must find $500 billion in new buyers, or watch yields soar. Higher yields mean more debt service, $85 billion extra per 25 basis point rise on $34 trillion debt. That's money not spent on schools or infrastructure. Wall Street expects the neutral Fed rate near 3.5% by decade's end if this shift accelerates, locking in mortgage rates above 7% and forcing municipalities to pay emerging market risk premiums. This isn't about sanctions or crashes. It's allies quietly voting with gold bars, signaling eroding trust. The dollar erodes gradually as central banks swap paper for metal. The Fed prints more dollars against shrinking collateral. Leverage built on trust vanishes once trust breaks. That's the real shock shaking Washington this summer. Germany and Italy are loading planes. Every pallet of gold flown home tears a hole in America's financial defenses. The chain reaction is clear. Tariffs rise, trust falls, repo markets choke, mortgage rates spike, and the dollar's dominance fades. If others follow, borrowing costs rise, the debt burden grows heavier, and Americans pay the price in pricier homes, cars, and roads. The deepest blow is psychological. Allies now prefer real metal over IOUs. In a system founded on faith, losing faith is the ultimate sanction. So what next? Will the U.S. back down, rebuild trust, and tighten its fiscal belt? Or double down, daring the world to find a better alternative? Because once gold leaves New York, the balance of monetary power shifts irreversibly. What moves first, the White House or the global money map?